Are we at a historical juncture? Well, we're going to see. Yes, in the US 10-year yield, we are making all-time lows. As we see here on these 3-year charts, we are even lower than the 2016 July low at 133. Of course, we've just broke 142 of last August, and it's now reaching this orange support trend line around 1%. However, the targets could be towards 0.5%. If we look at the weekly charts here from December, we should put that new low in a perspective, namely since 346 on the 30 years, at 165 now on the 30 years, we are almost at the end of a sequence of 5-wave down. So what we now have to look for is any kind of reversal. For example, if we would be moving above the 120, 125 gap that we just did recently, last week. That's the case, that could indicate that we could be close to a very important secular low. Of course, this new low happened at the same time as we can see here, we had this very sharp decline last week, about 11%. And we already are making some kind of rebound. Now, we should keep in mind that at the February high, there was no breadth narrowing. That means that the top on the February 2020 is not supposed to be a major top. Of course, when we have such a sharp decline as we see here on the last 6 months of the S&P, we had a very strong rise of the orange line here, the orange dotted line, which is moving all the way to 40%. When it reached such high, usually it is indicating that the market has probably hit the bottom of its range at least once. And that's the key. Usually when you have such sharp decline and a rebound, which is also making 50% of the previous decline, as we have seen here a few days ago, we are going to retest that major low. And this process of retesting can take a few weeks, even maybe some months, but usually a few weeks. And one of the reasons is that the market is not yet oversold because the decline has been very sharp. In fact, the steepest the decline, the longer the time to repair it. And that's why we expect a wide trading range for coming weeks. Now, how did it work globally? In Japan, in Asia, we also had the relative strength, which is the black dotted line here, was declining since December. And the move of the Nikkei just went from the top of the resistances around 24,000 all the way down to 20,000. So as long as it remains below 22,000, there is the risk of still a bearish pattern and a bearish development. And as we see here on the momentum side, on the stochastic or the MACD, on the downside of the chart, these are not yet oversold. Situation is relatively similar for Europe. Also, the relative strength line of Europe versus the S&P 500 was steadily declining over the last 6 months. It is now kind of bottoming, so all will depend on what the US market is doing. And we noticed that from the resistance trend line around 43, here we have been moving back to the cloud. Now a little rebound, and we need to see if that cloud is going to offer some support as the oscillator are entering oversold, but they are not yet fully oversold. And the last part of the global side is really the emerging markets. And emerging markets on the orange dotted line here had been moving down in January versus the S&P 500. So they were underperforming already. And that's what we saw already in January. And here we've got basically a movement, a corrective movement, which is probably complete. A down, B up, and C down. And if we are holding these support trend lines with a very already oversold stochastics here on a weekly basis, we might build a base in the coming weeks. So if we now think longer term and look at the last 3 years and look at what has happened when we had big down move in the past, in the recent past. In October 2018, we had a first down move, then it went sideways for a little while, a few weeks, and then it made a new low all the way to 2350. Therefore, here, given the very sharp decline that we just got, we need to expect more of a trading range between 2850, 2900 and 3200. Then, if we are lucky, the market will be oversold enough and there might be some good news which allow it to go on with the green path. But we still have to consider so far, given the price pattern and the sharp decline, 11% that we got in 1 week, that the red path could extend all the way into October to reach again the December low of 2018 in October of 2020. And that's a risk scenario that we still need to monitor and envision during the coming weeks. And we'll talk to you in 2 weeks. Thank you.